Hi there. I'm Nikhil K. Majitia, Principal and Portfolio Manager at Vedanta Sentinel Investment Advisors. We are an independent investment advisory firm based in Ann Arbor, Michigan. We work with clients and retirees here locally in Detroit metro area and throughout the United States. Again, we're fiduciary. We're required to do the best thing for you as the client, and we charge low competitive fees. We offer some unique investment solutions, including our flagship Sentinel strategy, which is designed to protect the portfolio downside when we have a view that the market is due for a big drawdown. Uh, Again, myself, Nikhil Majitia. You could visit our website here, vedantasentinel.com, and find out more. But the topic of today's discussion is the market indicator. So I'm sharing the screen with you. I hope you could see this here. If you go to markets and select market indicator, we're introducing this new resource as a tool that gives you a glimpse into how we think about managing your money when we allocate your money to buy securities. Good investing decisions always start with a clear and comprehensive view across the full landscape of what actually drives the investment returns. And our indicator dashboard is basically built to provide you a monthly view about the current landscape across four different dimensions. And we're sharing with you, obviously, our clients and visitors to this website so that you have a clear understanding of how we make decisions when we manage your money. So let's walk through this quickly. The indicator tracks 16 different data points, four across market index valuations, four technical indicators, four across economic data landscape, and then four macro and policy related data points. Um, and green means favorable, neutral means neutral. Blue means neutral, yellow means caution, and red means unfavorable. Taken together, something they combine together provide useful information about the current investing landscape. Not what the markets will do tomorrow or next week, but the overall backdrop on balance, whether the backdrop is constructive or challenging over an intermediate to longer term time horizon. We define intermediate to long term as few quarters, obviously, and beyond. So think of this as a weather map. A mostly green map does not guarantee sunshine, but it does tell you that conditions are favorable. If you see a lot of green dots, a map heavy in red or yellow, it generally indicates caution or to be prepared for some bad weather, and we should be prepared. We prepare accordingly. Think of it also as a dashboard in your car. One important disclosure, obviously, before we proceed forward. The monthly market indicator dashboard here on our website is provided as an open tool, a resource to our clients and visitors. It should be used for informational and educational purposes only and should not be used as a basis for making your investing decisions. It represents our internal framework for evaluating the market conditions and should not be used as a personalized investing advice. Investing decisions should always be made in consultation with your financial advisors, who understands you obviously and your unique situation, goals, and needs. So, with that, we'll just dive into it quickly. Uh, uh, First four data points we use is the market index valuations. We use S&P 500 index valuations here to measure the current picture, if you will. Shiller PE, price to sales ratio, equity risk premium, and earnings yield. And we do provide a comparison what the indicator data point is doing in the current month versus prior month. So you get a moving picture, if you will. Currently, as in the market valuation picture, has been unfavorable for quite a few months now. Shiller PE is over 40, price to sales ratio on S&P 500 is at over 3.38, which is historically high. Equity risk premium is practically zero or negative right now, versus what you get in terms of yield from risk-free bonds, government bonds. And that's why you see all of these earnings yield included as well. It's currently less than 3.5%. So combined, these four dots are in the yellow phase, indicating unfavorable valuation conditions. Now, market valuations can stay higher for longer, as you saw during the dot-com boom in 1999 and 2000. And we have a somewhat similar backdrop with the AI boom. So again, market valuations can stay unfavorable for a long time. But market technicals, number 5 to number 8, it provides you a glimpse of what the market is actually doing right now when looking at the technical components. So for the technical components, number 5, we have our proprietary flagship Sentinel technical indicator. That's a composite indicator that aggregates 8 different technical inputs, including market breadth, momentum, and volatility across key indices to assess the broad market risk conditions. And that it's a single aggregate indicator that we use internally for making investing decisions. Looking at the technicals, obviously, that's just one of the many things we look at. Volatility index, if you're following the markets closely, you may be well aware of the fear or VIX index, and that has been in the unfavorable range beginning this month. It was in neutral range last month, and now it's moved to unfavorable or red. Percentage of stocks trading above a certain level in the S&P 500 index, that's showing caution as well. So the technical picture right now, as of mid February, based on January data, month-end data, is mixed. Valuation picture is showing obviously a caution or unfavorable. And then at the bottom you see the basis which drives asset class return, the macro policy and the economic data. Number 9 to 12 is the actual economic data points. We're picking that up from 4 different segments here in the economy: manufacturing sector, service sector, unemployment rate, and retail sales. Some of these are stable or neutral, and a couple of these are in the favorable or green category right now. We use a new order subcomponent of ISM index because that gives us a glimpse into the next month, what the purchasing managers are doing, looking ahead over the next 1, 2, 3, and 6 months. So that's a forward-looking indicator. Some data points, number 9 and 10, and 11 and 12 are considered coincident indicators when we assess the market conditions. Number 13 to 16 are driven by obviously macro conditions, as is what is the economy doing. Is the economy weakening? Then you will have the credit spreads widening at the bottom. Currently the credit spreads are stable. Inflation backdrop is still above the 2% normal historical trend and the Fed's target, and that's why it's showing in caution. It's been trending down from about 3% last year to close to 2.5 to 3% range, but it's still in a yellow zone. Fiscal policy with the one big beautiful bill introduced last year remains favorable. A lot of people are expected to get heavy tax refunds this year, in the first half of this year, and that's why that's showing favorable. And the monetary policy is in neutral mode right now at 3.5%. Federal Reserve Committee members, based on their last meeting in January, indicated that they feel they're close to neutral, and the policy is neither restrictive or accommodative, and that's why we have this in the neutral zone, blue zone. So combine these 16 data points. I hope it gives you a flavor, or this indicator dashboard gives you an insight into how we look at things when we take the ownership of managing your money. Please come back to us, visit our website, give us a call. contact us 734-234-8742 or leave a message at 567 Vedanta or use this link at the bottom to schedule your meeting. Thank you.